Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today, we're opening up a file on a company that, well, at first glance, you'd think it's all about gaming.
Right.
But when you actually dig into the numbers, it starts to look a lot more like a piece of critical infrastructure. We're talking about Applovin.
And I think for a lot of people, that name still means one thing. You hear Applovin, you think mobile games.
Absolutely.
The puzzle apps, the little time wasters.
Yeah.
But looking at the research you've brought in, the Evercore reports, Q1 earnings, the Fitch ratings, it seems like calling them a gaming studio is, well, just wrong.
It's a fundamental misread. I mean, if you still think of Applovin as just a games company, you're looking at a picture from, 3 years ago? The company we're looking at today is the data calls it an apex predator in ad tech.
An apex predator.
Yeah. This is a story about a company that realized the real money wasn't in digging for gold. It was in selling the shovels. They've done from making games to building the software that powers the entire app economy.
So they're not just playing the game anymore. They're trying to become the stadium the game's played in.
That's a perfect way to put it. They're becoming the infrastructure. And the numbers behind this pivot are just staggering. We're not talking about small improvements here.
Okay, that's a huge claim, and I definitely want to unpack how they pulled that off. But before we get into the tech and that whole apex predator thing, just a quick note. If you find our talks useful, please consider hitting that subscribe, like, and comment button. It really does help us out.
It really does.
So let's start with this transformation. You said they're not a gaming company, but they did.
Yeah.
They did own studios, right? They were making stuff.
Oh, they were. And to really get the company today, you have to look at what they got rid of. They made this move that kind of confused some people, but had institutional investors cheering. They divested their mobile gaming business to a company called Triple Dot Studios.
So they literally sold the games.
Sold the games. And the deal itself tells you everything about their strategy. It was for $400 million in cash, plus a 20% equity stake in the new combined company.
$400 million is a lot of cash.
Yeah.
But usually you sell a division because it's failing, isn't that?
Yeah.
Was that the case?
Not failing so much as limiting. This wasn't just about raising money. It was about, clearing the decks.
Okay.
Think about the game-making business. It's hit-driven. It's a creative lottery. You spend a ton of cash on 50 games and hope one goes viral. It's low margin. It's capital-intensive. You're always on this treadmill.
Right. It's the Hollywood model. You need one blockbuster to pay for all the flops. It makes your earnings really volatile.
Precisely. But software, a platform that other people use to run their ads, that's high-margin, predictable, recurring revenue. So by selling the gaming part, they just stripped away all that volatility to focus purely on their software.
It reminds me a little bit of Amazon. Selling books is fine, but AWS, the cloud business, that's where the real profit is.
That is the perfect analogy. Amazon realized the infrastructure was way more valuable than the storefront. And this move for Applovin has completely changed their balance sheet. They don't have to pour money into content anymore.
So all that cash can go back into the core tech.
All of it. And it changes their identity on Wall Street. They go from being a gaming publisher, which gets a lower multiple, to a SaaS and ad tech powerhouse, which, commands a premium.
Okay, so the decks are clear. They're a pure software play now. Let's talk about that powerhouse claim, because I was looking at the notes on their Q1 performance, and I honestly had to check if it was a typo.
Hey, no typos there. The numbers are real.
The ad segment had adjusted EBITDA growth of 92%. To $943 million. Is that right?
It's explosive. But don't just look at the growth number. Look at the efficiency behind it. That same segment is running at an 81% margin.
That is insane. Usually in tech, you get one or the other, right?
Yep.
High growth, but you're burning cash. Or you're profitable, but growth is flat. To see 70% overall growth and 84% EBITDA margins, that's so rare. That's a unicorn situation.
It is the very definition of financial explosiveness. And it's the proof that the pivot worked. But the real question is, how? How do you get margins like that? And it all comes down to their engine, something called Axon 2.0.
Axon 2.0. I keep seeing this in the notes. Sounds like something from a sci-fi movie. What is this thing?
Think of it as the brain behind the whole operation. It's their proprietary AI recommendation engine. To get why it's such a big deal, you have to remember the old way of doing mobile ads.
Spray and pray.
Spray and pray, exactly. You'd show a generic ad to 1 million people and hope a few hundred click. It's just so wasteful.
Right.
Axon 2.0 is a sniper. It uses just massive amounts of data and machine learning to predict with incredible accuracy which specific user is likely to install an app, and more importantly, which user is likely to spend money in that app.
So it's not just looking for clicks, it's looking for value. It's hunting for the whales, so to speak.
Correct. It's hyper-personalized ad targeting at a scale no human could ever match. It's finding the perfect ad for the perfect person in real time. And the margins are 81% because once you build the software, running it is cheap. The AI does all the heavy lifting.
And the impact of turning this thing on was immediate.
Immediate and violent in a good way. The jump in revenue per install just proves the AI is way better at finding customers than anything that came before it.
But they can't be the only ones doing this. I mean, you've got Google, Unity, IronSource. These are huge companies. What makes AppLovin's engine better? Why are we calling them the apex predator?
And that brings us to the moat. In the software world, the moat is what protects your castle.
Yeah.
Right. For Applovin, that moat is built on two things: network effects and their ecosystem, specifically a platform called Max.
Yeah, Max. Okay, what is Max?
Max is their mediation platform.
Right.
So without getting too deep in the weeds, mediation is basically a piece of software that app developers, like the guys who make Candy Crush, they put it inside their app. And its only job is to help them sell their ad space to the highest bidder. It's like an auctioneer.
So if I'm a developer, I install Max, and it runs a little auction every time an ad needs to be shown, getting me the best price.
Precisely.
Yeah.
It manages the bidding war for your screen time. And here's the key stat from the research. Max is integrated into over 100,000 apps.
100,000. Wow. That is a massive footprint.
It's huge. And because they're inside all those apps, they have this end-to-end view of the user. They aren't just guessing, they see the actual data flow. And this creates a really powerful network effect.
Walk me through that loop. How does the data create a moat?
Okay, so the more apps use Max, the more data Axon gets to learn from.
Right. It sees what games you play, what ads you click on.
Everything. So the smarter Axon gets, the better the ad targeting becomes.
Yeah.
And the better the targeting, the more money the developers make.
Which means more developers want to use Max.
It's a flywheel. It just keeps feeding itself. And that makes it really, really hard for a developer to switch to a competitor like Unity or IronSource. The switching costs are just too high because the performance gap is real. You don't leave the winning horse.
Okay, that makes sense. But there's another layer here we have to talk about, the elephant in the room for all of ad tech for the past few years.
We need to talk about Apple.
And their privacy changes.
Yes. ATT, or App Tracking Transparency. It was a hurricane for the entire industry.
The Ask App Not to Track button. I hit that every single time. And I'm guessing most people do.
The vast majority. And it just destroyed the old way of targeting ads. Companies like Facebook and Snap, they relied on tracking you across apps with these little ID codes. When Apple cut that cord, they basically went blind. Their ad businesses took a huge hit.
But the thesis here is that Applovin is somehow immunized against this. How is that possible?
This is the genius of the Max platform. Because they are inside those 100,000 apps and because they run the auction themselves, they get access to real-time impression-level data. They don't need to track you across the web.
So they see what's happening in the moment inside the app.
You have total auction control. So while everyone else was blinded by Apple, Applovin just kept on seeing. They use contextual first-party data, which is allowed, instead of that third-party tracking, which is now blocked.
So they basically own the house where the auction happens.
That's the perfect way to put it. And the proof is right there in the numbers. They reported a 49% increase in ad net revenue per install. That metric just proves their AI is working better in this new privacy-first world.
That is fascinating. So they built this incredible moat. But where do they go from here? They're not just sticking to gaming, are they? I saw some notes about expanding.
No, they're not stopping. And this is where the TAM, the total addressable market, gets really exciting. They're taking this Axon engine and pointing it at new sectors: e-commerce, fintech, and connected TV.
E-commerce seems like a big jump for mobile games. I mean, does the tech even translate?
You'd think so, but the mechanics are identical. It's about matching a user to a product. Whether that product is a new sword in a game or a new pair of shoes, the AI works the same way. It's analyzing behavior to predict intent. This expansion adds about $50 billion to their addressable market.
50 billion. Wow.
And there's another catalyst here that's got analysts buzzing. It's not confirmed, but there's a lot of chatter about a self-serve Axon ads manager.
Self-serve, meaning I don't need to talk to a sales rep. I can just log in and start buying ads myself.
Exactly. Like Facebook Ads Manager. If you're a small business, a local shop, a startup, You log in, set a budget, and hit go. If Applovin releases a tool like that for Axon, it opens the door to millions of small, direct-to-consumer brands.
That would be a game changer. It puts them in direct competition with Meta and Google for all those small business ad dollars.
It does. It basically democratizes their AI. It takes them from being a tool just for big game studios to being a mass-market advertising utility.
Okay, so the tech is there, the strategy is clear. Let's talk money. What are the folks on Wall Street saying? Because with a story this good, the stock is usually already priced for perfection.
Well, the mood is incredibly bullish. The proprietary score in our research is a 9 out of 10. But the big call everyone's watching is from Evercore ISI. They just initiated coverage on January 14th of this year, 2026.
So fresh off the press.
Very fresh. They slapped an outperform rating on it. But look at the price target, $835.
Whoa, okay. $835, that implies a lot of runway. How did they get to that number? What's the valuation look like?
It comes down to the multiple. Even after the huge run-up we've already seen, it's still trading at about 25 times CY26 EBITDA.
25 times forward earnings, which for a utility company would be expensive, but for a tech company growing at this speed.
For a company growing at 70%, 25 times is actually kind of cheap. You usually pay a much, much higher premium for that kind of growth, maybe 40 or 50 times. So the argument is the stock is still a good value relative to its growth rate.
The Jorpay argument. Growth at a reasonable price.
Exactly. And from a technical perspective, the charts are setting up for what analysts are calling a golden buying opportunity heading into earnings. The expectation is a breakout to new highs.
And they're not just sitting on their cash, are they? I saw something about buybacks.
Very shareholder friendly. They have a massive $3.2 billion buyback program. That's a huge vote of confidence from management. They wouldn't be buying back their own stock if they thought it was too expensive.
Right, they're eating their own cooking. And what about the credit rating? I saw Fitch weighed in.
They did. Back in November of 25, Fitch upgraded them to BBB. That's investment grade. And that's a big deal. It opens the door for a lot of big institutional funds that can only buy investment grade stuff. It just validates the whole story. It says this is a real, solvent, profitable enterprise.
Okay, so investment grade rating, huge buybacks, 70% growth. It almost sounds too good to be true. And we have to play devil's advocate here. What's the bear case? What could go wrong?
It's a fair question, and you have to look at the risks. The biggest one people talk about is Alphabet. Specifically, something called Project Genie.
Project Genie sounds ominous. Is this Google's secret weapon to kill them?
It's their attempt to use their own AI to get into this space. And the fear is simple. Google is the 800-pound gorilla. If they decide they want your lunch money, they can usually take it.
And that's a valid fear. We've seen Google kill entire industries just by changing an algorithm.
It is, but the counter-argument, and the reason the market seems to be dismissing this, is that it's kind of irrational to think Google can just muscle them out at this point.
Why irrational?
Because Applovin is just too fast and too embedded. Remember those 100,000 apps using Macs? They're entrenched. The switching costs are too high. A developer isn't going to rip out the system that's making them a ton of money just to try some new Google experiment. The moat is just too deep now.
Okay, so maybe the Google threat is overblown. What about the broader economy? A recession?
That's the other real risk, ad market volatility. If the global economy slows down, ad spending is one of the first things to get cut. That's just a fact of life. That could cause an earnings miss.
Right, but I guess their margins help protect them there.
They do. That 84% margin is their buffer. It's a huge cushion. It lets them absorb a lot of pain. And as they move more into e-commerce and self-serve, their customer base gets more diverse. So they're not just relying on a few big gaming clients.
It makes the whole revenue stream more robust.
Exactly. Smooths out the ride.
So let's bring it all home. We've covered the pivot, the AI, the moat, the expansion. If you had to boil down the whole thesis into a nutshell, what is it?
The thesis is this. Applovin is an apex predator with a real, proven AI moat in Axon 2.0. They have this incredibly rare combination of 70% growth and massive profitability. They have successfully become an infrastructure play for the entire app economy. And even with the run-up, the valuation suggests there's still room to go. This is a multi-year hold looking at the catalysts from e-commerce really kicking in through 2026.
So it's not just a trade, it's about owning the infrastructure.
It's owning the rails of the mobile economy.
That is a powerful way to look at it. You know, when we talk about building wealth, we're always looking for companies that are indispensable. It sounds like Applovin has made itself indispensable to this whole ecosystem. You need them. And that's a very, very good place to be.
It's the best place to be.
Well, there you have it, the apex predator of ad tech. As always, do your own homework, but this is definitely one to keep on your radar. Thanks for breaking this all down today.
My pleasure.
And thank you all for joining Smart Wealth with Joshua. We'll see you in the next one.